SeizYourBusiness.com podcast with Tony Rourke and Kevin O'Flaherty.
SeizYourBusiness.com, making you money.
Share it on Facebook, share it on LinkedIn,
Twitter, our blogs, YouTube videos, listen to our podcast. It's so hot that it's burning up the stereo.
Welcome to the SeizYourBusiness.com podcast. I'm your host, Kevin O'Flaherty. Tony Rourke couldn't make it today, so I've got Scott Mathis from Plateau to Peak Consulting sitting in for him, and I'm from O'Flaherty Law. If you enjoy what you hear on the podcast and you'd like to help us out, please review us on iTunes. That's the number one thing you can do for us. You can also share us on social media, and we'd appreciate that as well. Our guest today is Karla Moye from Moye Moye Accounting, and our topic today is going to be tips for business owners from an accountant. We're going to spend a lot of time focusing on things that a business owner can apply that is in an accountant's brain, and we're going to try to extract. So, Karla, why don't you start off by just telling us about your firm a little bit?
Thank you, Kevin. I'd be more than happy to. The firm that I work for is owned by my father, whose name is Terry Moye. He has been an accountant for the last 40 years. He originally started out as an auditor who specialized in severe tax cases, including corporations with multi-year audits, millions of dollars owed to the IRS, etc. So when he started his own firm in 1979, he decided that he wanted to work with those people to help them and be their advocate. And this is my 11th year working with him. And because his specialty is people with severe tax issues, I have also specialized in people with severe tax issues. So I feel like we have a wide breadth of tax knowledge that not a lot of accountants are able to work with due to the fact that our clients are somewhat special in their needs for taxes. We're actually a full service accounting firm. We have clients that range from $100 to $1 million corporations to very small individuals with, just basic income. So we provide a long list of services.
And, from my personal experience, I've been through a couple accountants, and you're my current accountant, and you've done my past couple of years of tax returns. When I first started out, the first accountant I went to just said, I went at the beginning of my business and said, what do I need to know about accounting? And he basically told me, well, come to me at the end of the year and, we'll get your tax returns done. And I was crawling in the dark trying to figure out QuickBooks and doing all sorts of things wrong. And I cost myself a ton of man hours just trying to, fix the things I did wrong in my first year without proper guidance. And then I got an accountant that gave me a little bit of guidance. But when I brought the tax returns to you, you saved me, something like $10,000 or $15,000 by amending them and doing them right. So how can someone find out, it's hard to tell if someone's a good attorney just by, meeting with them. It's hard to tell if someone's a good accountant. What should people look for when they're looking for an accountant?
Well, I think with accounting, just as with having an attorney, you'll know that the person is giving you excellent service and doing your company or yourself a good job if you feel confident in the knowledge they give you about your own tax situation and explain to you if you owe money, why, where the taxes and or penalties are coming from, or if you're receiving a refund, why you're receiving a refund, and the process of your income, your deductions, your taxation, and in the end, your final tax liability. So once you have a good understanding of that, you can feel confident, and then I feel confident because my clients also have the same understanding.
So when you have that first meeting with a new business owner who's just opening up their shop and saying, it's January and in a year I'm going to have to pay my taxes, what do I need to do throughout the year to plan properly? What sort of things do you tell them?
Well, I think the biggest misconception is that your accountant is the person you should see once a year. I feel that, the most important things to have in life is a good doctor, a good lawyer, and a good accountant. So if you approach your accountant and tell them I'm starting a business, I'd like some advice on what to do throughout the year. My advice to that person would be keep as accurate of records as possible. If you personally or no one that works for you can do that type of service for you, either a bookkeeping or just a general accounting, then it's always good to outsource that to either a professional accountant or a professional bookkeeper. Because as I've told my clients, the best offense and defense against the IRS is good records. And the best records you can have are accurate monthly bookkeeping that exactly match the bank statements and exactly matches the payroll and the income and the expenses for the month.
Do you see a lot of people that try to do their own bookkeeping and cause more problems for themselves than just having it outsourced?
Unfortunately, yes. There are a lot of great softwares out there, QuickBooks, Quickens, various things by Intuit. And a lot of people will, have taken maybe a basic accounting class in college, or they watched a webinar about it, and so they'll attempt it. But to have a really good understanding, especially a company that has, accounts receivable, accounts payable, maybe multiple assets within the company, it's a little more difficult than the basic software will allow you to do. So even if you do the accounting on your own, if you want to, it's best to at least have some instruction from someone such as a professional accountant who can at least get them started in the proper way, and they can follow the lead for the rest of the months of the year.
So you can train, let's say I've got an office manager and she doesn't know anything about QuickBooks. You can come in and train her how to keep the books in a way that'll make things easy for you, so we don't have to do a lot of cleanup when it's tax time.
Exactly. I feel that every accountant has their own method of doing bookkeeping. They're very similar. However, some people like to have more detail and others prefer to be more general. I think that when I teach managers, office managers, the type of accounting that I do, the type of bookkeeping, it's definitely more specific, because when my business owner looks at his books at the end of the year and sees a large charge for something under the title of professional fees, he might say, wait a minute, professional fees, that could be any number of things. I need to know exactly what those are for. So then we'd break it down: attorney fees, accountant fees, engineering fees, things like that. So I prefer more of a specific approach than to a general approach.
Yeah, I have a quick question. If tomorrow I'm opening a business, I'm a new entrepreneur, I'm whatever the business is, what piece of advice after your years of doing this, you said 11 years, right? What is the biggest thing I could either hurt myself or help myself in doing? What's the number one thing you would suggest? I came in, I sat down and talked with you. What's the biggest thing I could do to make sure I'm successful in keeping track of my numbers?
Well, what I would say is the corporate structure needs to be appropriate for your goal. So if you wanted to start a limited liability corporation, the purpose of that would be to reduce the personal liability that you have as an owner with your personal assets and incomes from the corporation. And going from there, we would want to make sure that we separate you personally and the company in everything from income and assets to liabilities and responsibilities. Now, a lot of, especially celebrities, I think in the past, have run into the situation where they have a business, the business failed, perhaps there was an angry customer or an account, and they've been sued personally. Kevin probably can name any number of situations, and they've lost money because their company wasn't structured in the proper way.
Right.
So number one, always want to protect the client, because not all businesses succeed, but especially if they do succeed, you want to make sure that they are set up in a way that it affects the taxpayer, it keeps their tax liability legally as low as possible.
Right.
We're getting into my wheelhouse here, because I do a lot of discussions with people about, different corporate forms and stuff like that. And the decision that most people have to make is between, an LLC taxed as an SCorp or a corporation taxed as an SCorp. And what I usually tell them is that from a liability perspective, there's not really much of a difference. From a tax perspective, as long as you're taxed as an S-Corp, my understanding is there's not too much of a difference between the two setups either. Am I wrong about that?
No, that's correct. They're both considered a pass-through, so which means that any income that is made by the company according to the tax return is then split up by the owners, whether it be one owner or multiple owners, and each would take that share of profit or loss on their personal tax return. Now, for some clients, this is a great situation because they may have numerous rental properties, and ones that lost money negate the ones that made money, so they don't have to pay any additional tax on it. But can also be prohibitive if you've had a company that makes a good amount of money in a year, and then that owner needs to take that income from the company on their personal return, which adds to their personal tax liability. Now, it is taxed at a lower rate instead of the income tax brackets. It's taxed at a lower rate, but it can make a big difference, especially if somebody has a very successful year and doesn't realize it until tax time.
So where's the threshold of when it makes sense to not be an SCorp just for tax purposes? Just, because you don't want to take the personal profits out of the company.
Well, there's a number of factors in there, but I would say the biggest one is the size of the company and the amount of time you spend in the company. So if it is your main source of income and it is your, 100% is what you're focused on with your career, then I think having it as a corporation, as an SCorp or an LLC is necessary. But if you are, let's say, maybe a partner, silent partner in name only, for a corporation, it's not too concerning because your activity, you're not considered an active partner, you're considered a passive partner. So realistically, if you have gains or if you have income, you could even defer them for future years.
I have a question. It comes up quite a bit in circles I'm in. Stuff people talk about, like, you can only lose money so long as a business before they stop letting you take it as a write-off. Any truth to that?
I'd like to point to companies like Wachovia Bank, which was purchased by Wells Fargo. Yeah. They lost money for a very long time. Yeah. And some companies have been, have lost money for 10, 20 years. Yeah. And of course, eventually they'll get sold or purchased by another company. But there isn't really a time limit on losses for a corporation as there would be for a self-employment business. For instance, if you had a business where you made a product at home and you reported your income and expenses on your tax return on a form known as Schedule C, which is self-employment, and you showed a loss for the first year, that's understandable because with expenses and startup fees, it can be quite expensive. For the second year, maybe, show a small loss. Third year, showing a loss is not good. And then once you get into the fourth and fifth years of showing a loss, then you start to not necessarily raise red flags, but it starts to become a question of whether or not it is either a employment or it's a hobby. Because hobby income, you need to report. Self-employment income, you need to report. Hobby losses don't exist, whereas self-employment losses do. So the IRS may come to you and say, you have been not profitable for the last few years. We're going to change this, and you are now going to be reporting this as a hobby as opposed to an employment.
Is there any back liability as it relates to going back a few years? Can they go back and ask you for more money because it shifted to a hobby, or when they see it, then they can change it to a hobby or not?
Now, in my experience, they won't go back for a hobby or self-employment.
They just switch it from that point
Correct.
forward.
They'll tell you this is how it needs to be listed in the future.
I've got two things I want to backtrack on. One is deferring income and how that works. But the first thing I want to kind of wrap up LLCs and S-corps, and one thing that people don't really understand often is that they say I'm deciding between an S-corp or an LLC. They don't understand that at the Secretary of State level, you're either an LLC or a corporation, and then at the IRS level, you choose to have your corporation that you set up or your LLC set up taxed as an S-corp or not. And just to make things clear, this isn't really leading into a massive question, but so the LLC or the corporate setup that'll protect you from liability. If you're set up as an LLC, you get passed through income, so you're not taxed once at the corporate level and then a second time on the payment that you get from your corporation. And I want to explain that real quick. When you're taxed, when you buy stock in like Coca-Cola, the corporation is taxed, and then you get paid a dividend, and then you're taxed on that income from that dividend. If you're set up as a C corporation, which is just the standard way to set up your corporation through the Secretary of State, your corporation gets taxed on its corporate income. Then when it pays you money, you get taxed on the income that your corporation paid you. So it's a double taxation. We avoid that by slapping the SCorp tag on your corporation, applying to be an SCorp with the IRS. And the way that works is now you've got pass-through taxation for your corporation that you set up. Well, if you've got an LLC, you've already got pass-through taxation going on, but there's still a benefit for doing the SCorp tag, and that's saving on self-employment tax. And do you want to talk a little bit about how saving on self-employment tax by being an S-Corp works?
Sure.
You want me to talk about that?
Well, a lot of times I'll see a person who has a home business and they will want to report their income on a Schedule C. Now, Schedule C, you're not receiving a paycheck like you would if you work for a corporation where you'd have Medicare and Social Security tax withheld. Therefore, on the tax return, there's something called self-employment tax, which is the recapture of the Social Security and Medicare tax on your taxes that you would normally have, but since you're self-employed, you don't. Now, that gets added onto a part of the tax return called additional taxes. So regardless if your tax liability from your income is zero, you still may be liable for self-employment taxes, which means it's a higher percentage of tax that you'd be paying on that income. So if you chose to go with an LLC, or in Illinois, you can be an SLLC, which is a sole member LLC. Because a lot of times when people think limited liability corporation, they think that there has to be more than one member. Not true. When you use the LLC to avoid the self-employment tax, you no longer are responsible for that portion on the additional tax of your tax return. Now, if you take distributions as income, it's possible that you may have to pay some self-employment tax. However, if your accountant sets it up correctly, you shouldn't have to.
And correct me if I'm wrong, but the way I understand it is if you're an LLC that is not an S-Corp, any money that you make from the company, since it's passed through taxation, you're going to be paying self-employment tax on, right?
Yes, but it's not the entire amount that you would be paying tax on like you would if it were a straight self-employment. It's only a percentage it's a lower percentage than what you would be paying if you had the LLC in place versus the other method. The self-employment method.
So
sorry, I think I tongue-tied myself there.
And so just to make things clear, and Scott, we work in this world all the time. So, and you're pretty savvy too. But if we're talking too arcane, slow us down. If you have any, if you think the listeners might have some questions that we're not covering. But so the income tax is one layer of taxation. Then on top of that, you're paying self-employment tax.
Mm-hmm.
And if you're an LLC, that's not an S-Corp, you pay self-employment tax on at least a large percentage of everything that you're bringing in profit, right? But if you are taxed as an S-Corp, what you can do is pay yourself a salary, and it's got to be a reasonable salary. So I can't, if I'm an attorney working in my law firm, I can't necessarily pay myself a $5,000 salary. But you pay yourself a salary, and then you pay self-employment tax on that salary. And everything over and above that you take from the company, you take as a shareholder distribution, or sometimes called an owner's draw. And that distribution is free of self-employment tax, right?
Correct.
Okay. So just to break it down, I usually draw this out on a piece of paper. But if I've made $100,000 that I want to pay myself for the year, and I can get away with paying $50,000 of that as salary, and $50,000 of that is profit or distributions, owner's draw, whatever you want to call it. Only the $50,000 that I pay as salary is subject to self-employment tax. The $50,000 that I take as profit is not. So I'm saving on taxes by being incorporated. And so a lot of people is that all accurate?
That is very accurate.
So a lot of people that come to me and say, I've got, let's say an event planning business and I'm not worried too much about liability. Does it still make sense to incorporate? What I'll say is you should talk to your accountant to find out if the savings you're going to have on self-employment tax outweigh the filing fees and attorney's fees you're going to pay to incorporate. And that's based on how much they think they're going to profit in their first year. If they reach a certain threshold where they're saving more than $1,000 on self-employment tax, then that's going to pay for them to incorporate. And anything above that, they'll get, free and clear and be saving money.
And one thing I see with clients, especially who are the higher income levels, maybe single or married people over $200,000 of income, they should actually incorporate their business, whether it be a rental property or a small percentage ownership in a company, because when your income is a certain level, you can't take those losses on your return if it's not into a corporation. So if I have a client who makes $200,000 a year, has a rental property that lost money, they're out completely. The loss on their tax return from that rental, which would benefit them, lowering their total income because their income is too high. So in those cases, especially, I tell the clients it's necessary and beneficial for you to create a corporation for this venture so that you can still take advantage of the tax breaks.
And if all of that sounded really arcane, all you really need to know is that you need a good accountant and you need a good attorney, and we can explain that to you. The other question I had from what we were talking about before is how does deferring income work? Can you go into
Sure.
how that works?
So I can give a good example. I have a client who owns a medical practice, and she is very successful. During 1 year, she purchased a building in cash. She hired many employees, but her income was still high enough that her personal tax liability was going to be very high. Now, one of the things that the company can do is retain some earnings. So instead of paying her the equivalent of, the distribution, the owner's draw, we put the earnings and we kept them in the company for that year. We retained them so that she could take them in a future year. Now, some people will do this if they want a large payout in the future for whatever reason, and some people will defer income because their personal situation outside the company, perhaps there's a large taxation that's coming to them. And you can't do that forever, but you can do it. You can spread it out for a number of years. You can also spread losses for a number of years. So some people may take a very large loss 1 year, perhaps if they buy a building or a large piece of equipment, and sometimes they'll break it down over a number of years, whichever one helps their personal tax situation the best.
And is that something that the business owner really has to worry about, or is that, you get a good accountant and your accountant figures that out?
I think your accountant would tell you, here's the scenario. This is what your income is this year. This is what your tax liability is going to be. We can defer income, option A, we can do this. Option B, we can do this. Which one would you prefer? And I feel like the accountant should always give their client the option of taking more than one, route through the tax return that year.
And when you defer income, do you actually, in real life, have to hold off on paying yourself that money?
Well, yes and no. You can do things such as put it into a retirement account or an investment account that's held through the company. You can also take it as a distribution for perhaps if you have a capital account, which is the money that's put into the company by you personally. If your capital account is high because you've contributed a lot to the company, then you can use it to offset that, basically paying yourself back for a loan that you gave to the company.
And that wouldn't be treated as income?
No, it's not a taxable event because it's basically taking money from your right pocket and putting it into your left pocket.
Okay. How about that? I think those were great answers. What are some tricks is a loaded word, but what are some tricks business owners can do to maximize the amount of deductions that they get? People ask, should I get a company car? That's one of the things I'm going to ask you when we meet about my taxes soon. And you already told me the answer is yes, but I need to talk to you about it more. What are some things like that the business owners, before they meet with their accountant, should be doing to, maximize the deductions that they get through their business?
Mm-hmm. Well, I think one thing they should always know is how the company is performing throughout the year. So if I call up a client, hopefully any one of my clients that I do bookkeeping for during the year, and say, what was your best month so far? I would hope that they would have an answer for me. So if you're a business owner and you recognize that your company is being very profitable for the year, there are a lot of things that you can do before the end of the year to offset some of those potential taxes that you would incur. Obviously, purchasing things in the name of the company is always great, which could be an auto, some computer software equipment. I've had some clients that purchased a different office space, larger office space. I suppose it depends on the industry. But one of the biggest ones that people don't think about is either a company-owned investment account or a company shared retirement plan. So being that, a business owner, a lot of people don't think about having a retirement plan through their own company. They'll do it through their financial planner. But a company-owned business or a company-owned retirement plan means that all the money that's earned and then put into this retirement plan is now tax sheltered, in the sense that once the money is distributed for retirement purposes, you only have to pay tax on the gains as opposed to the distribution or the original investment, which is very good for business owners, especially who may not have a lot of retirement opportunities once they decide to retire.
With those retirement accounts, one of the things that I've struggled with is that, so you get your traditional IRA and you can put away your $5,500, but when you're making, more money as you're getting successful, there's a threshold where you start considering things like a SEP IRA or a 401k for your company. The downside to doing those is that you've got to match your employees' contributions as well.
Well, that is true and false at the same time. So a SEP IRA, or a self-employed pension, is a SEP, and that can be just one person. So if you're a business owner, you can have a self-employed pension where you contribute to it much as you would if you were in a union, and then at the age you decide to retire, you structure your pension benefits, being a lifetime benefit, a certain amount. There's a million options out there. Now, 401k, yes, that is, you are required if you have a certain number of employees and they work over 38 hours a week, I believe it is, you do have to contribute a percentage of the amount that you contribute for yourself. It doesn't have to be equal because obviously, the owner is not equal to his or her employees. They are treated just a bit better. And then we have other plans. There's a KEO plan, which is another type of retirement. And then there's a simple plan, which is, another one. These are ones that you do need to contribute a portion of what you contribute to your own plan to your employee's plan. So depending on the size of your company and the amount of profits, it depends which plan would be the best for you in your situation.
And to me, the analysis would kind of be, if you're saving enough money that you're covering on taxes that you'd be covering what you'd be paying to your employees, or it's close, you might as well give that to your employees rather than to the government, right?
I agree. I'm always in the corner of providing benefits to yourself and your employees. A happy employee is a successful employee.
I want to go back to the SEP plan. So with the SEP, you don't have to contribute for your employees. You're saying you can stash away more than you would in a traditional IRA, but it doesn't have the downside of having to contribute to all of your employees' retirement.
That's correct. The limit for contributions goes up every year for cost of living increases. This year it was $52,000. Last year it was $51,000. Basically, the IRS will give you a credit or a deduction for any contributions to a retirement plan, a qualified retirement plan, not just a coffee can in your backyard, because they don't want to have to provide for you when you get older and retire. People aren't surviving on Social Security alone. So they want you to save for your future and be able to provide for your own retirement. So in the case of somebody who works for a corporation and receives 401k contributions and as well as having maybe an outside retirement plan, an IRA, the most you can contribute, including your personal contributions and your employer's contributions, can never be more than this year $52,000, last year $51,000, because if you could contribute more, then the people who have lots of money to contribute would be taking advantage of that. So realistically, the rule for a SEP is you can contribute 25% of your income for the year, your gross income, up to $52,000 for the year, which for some people is extremely beneficial because it's a lot more than they would receive were they working for a corporation and then receiving 401k contributions.
Is there any downside to a SEP if you're a business owner as opposed to a traditional IRA? I assume there's, maintenance fees that.
Well, I suppose, any brokerage house, the only downside to an investment such as a SEP or any retirement plan is that it has to be a long-term investment. You will receive, penalties if you take the money out early. So the idea is to keep it until you need it. But one of the benefits is, as a business owner, you can take a loan against your retirement, use it for business-related things. Sometimes there's 15 exclusions for taking money out of a retirement plan early if to avoid the penalty for it. So when it comes to these accounts, depending on the circumstance that you need the money for, that you take it out, the penalties can be very low. But it's always good to have something, I guess you could even call it an emergency fund,
Sure.
A retirement plan that you can either use for retirement or you can use it just to defer income tax from your corporation.
I had a follow-up question, then my brain just went blank. So, okay, the deadline to contribute to a SAP or to a traditional IRA or to a 401k, is that April 15th of the following year?
Yes, that's correct. A lot of accountants will say to their clients, if they have a tax liability, if they have some tax that they owe at the end of the year, would you be willing to contribute some of your income to a retirement plan before April 15th? And you can still take that deduction on your tax return regardless of the day you file it, as long as the money is put into a qualified account by the 15th.
Since we're talking today on April 16th, I have to ask a follow-up question. Is there any wiggle room on that deadline, or is that a hard deadline?
Well, there are some wiggle rooms, and those are very specific for a certain number of people who are American citizens living abroad, people who are in the military on active duty, people who have to work overseas for any reason. But when it comes to a good old citizen working inside the 50 states, there's no wiggle room.
Okay.
The IRS is fairly cut and dry about that one.
Scott, do you have any questions that have come up from that conversation?
I don't. You did a good job going through that.
So, Karla, if
Some great comments.
I know you're a big reader, what's your favorite business book?
Well, I did read a book many, many years ago called Get Out of Your Own Way, which a book my mother gave me. She was an English teacher for 34 years. And it's all about confidence and self-actualization. The idea that if your biggest defeat is yourself, saying, I can't do this, I can't accomplish this. And in my history, 11 years ago when I started doing taxes, I had 4 clients, and they were my friends. And this year I did over 1,000 tax returns.
They're
business,
still all your friends.
of course.
Just that popular.
Your tax clients should always be your friends. So I would say that if I had any negative feeling about my success as an accountant, my history has proven that it's not true. And, being a positive influence on your friends and family is always going to improve your business regardless of what you do.
Well, thanks so much, Karla. If someone wants to have you do their taxes or have you help them out with a complex IRS issue, how can they reach you?
Well, you can email me or access my website, which is being redone, which is Karla Moye Accounting, KarlaMoye, the word accounting.com. And my office is in Oak Brook. And I always enjoy going out to lunch to meet a new client, so they can decide where they'd like to meet me, and hopefully I'll have time to show up.
One more question for you. What's your geographical scope of where you'll take clients?
Oh, well, that stretches very far and wide. I have a client who's in Japan right now, and I have many clients in California, Florida, New York. So basically, I can do tax returns and corporate returns in any state and any client that's living abroad at the time. The internet is a wonderful tool that I use for communication. So really, there is no scope. It's just as long as they're willing to send me their information, I can do their return for them.
Karla is my accountant. She's done a great job for me. So testimonial there. Thanks so much for being with us today.
Thank you for having me.
Appreciate your time.